Imagine a country. Its army may be very strong, its navy may overflow the oceans, but its real power is not hidden in weapons or ships. It is hidden in debt notes, interest rates, and credit networks. We are talking about the kind of power that can keep its impact even when wars are over. Of course, the power we're talking about is British bankers. So how did British bankers shape the world not through military conquests, but through financial ties? Who built the global debt markets? Who steered the reserve currency system? And why did London stay standing while many states were in crisis? In this series, we will open up not just history, but the inner workings of the financial mechanism. If you enjoy learning the behind the scenes of economic history, I sincerely ask you to support the channel by subscribing and liking the video. Because the story we are about to begin reaches into the foundations of the modern global financial order. Toward the end of the 18th century, England began to move beyond being an ordinary trading state and started turning into a financial power center. At the core of this was not only the income obtained from colonies, but its disciplined approach to debt management. The British Treasury was constantly borrowing to finance wars, but this borrowing was not happening in a disorderly way. Government bonds were issued systematically, repayment plans were clearly determined, and investors were given confidence. This element of trust was a critical threshold, because in the world of finance, people think the most valuable asset is money, but in reality, it is trust. The bond markets that developed in London eventually became one of the most liquid and deepest markets in Europe. British bankers began financing not only their own state, but other states as well. At this point, the balance of power quietly changed. The side that lends has an invisible sanctioning power over the side that borrows. The side that sets interest rates, manages the repayment schedule, and shapes credit conditions was also indirectly influencing political decisions. During the Napoleonic Wars, England made enormous military expenditures, but instead of collapsing, the financial system grew. The reason was that a strong investor base had formed in the domestic market. The Bank of England and private banking families supported government bonds and protected market liquidity. In this way, the war economy was carried out with financial discipline. The real secret of British bankers was the distribution of risk. Debt was not loaded onto a single source. It was spread across a broad investor base. This model was both sustainable and scalable. By the time the 19th century arrived, London was no longer just a capital, but a center where global capital gathered. Insurance markets, trade finance institutions, and international credit networks came together here. As British bankers took on the financing of world trade, they also began to determine the direction of money flows. By the end of the first episode, the picture was clear. England supported its military power with financial architecture and used debt not as a weakness but as leverage. In the next episode, we will examine step by step how these banker networks began to control intercontinental trade routes and the global monetary system. British bankers' influence went beyond national borders and did not remain limited to government bonds. The real transformation occurred when they began controlling the financing of trade. As world trade expanded rapidly in the 19th century, the secure and fast transfer of money became just as critical as the movement of goods. At this point, London-based banks assumed an important role. The letter of credit system, long-term trade loans, and insurance contracts were standardized by British financial circles. When a merchant brought goods from Asia, the payment was often guaranteed through London. This was not merely an intermediary service. It was the construction of the trust infrastructure of global trade. The party that managed trust naturally gained the power to set the rules of the game. Bankers in London responded to risk calculation, interest rate determination, and collateralization with systematic models. In doing so, They became the reference center for international transactions. Money transfers, insurance premiums, and credit commissions were gathered within the same financial ecosystem. This structure created a chain reaction. The more transactions passed through London, the greater liquidity increased. As liquidity increased, London became even more attractive. British bankers also played a significant role in the global acceptance of the gold standard. Sterling became a reliable reference currency in international contracts. This provided England with an invisible advantage. The widespread use of its currency lowered borrowing costs and granted pricing power in global trade. Many countries applied to London banks to finance their foreign trade. Borrowing was not only a financial matter but also a strategic relationship. Credit conditions, repayment schedules, and collateral structures could influence countries' economic policies. British bankers were not direct political authorities, but through financial ties they established an indirect sphere of influence. Marine insurance was also a critical part of this network. Institutions such as Lloyd's calculated risks, arranged ship and cargo insurance, and increased the security of international trade. As risk decreased, trade volume expanded. As trade expanded, the financial sector grew even stronger. This mutually reinforcing mechanism positioned London at the center of global finance. By the end of the second episode, we see that British bankers did not merely lend money, they built the roads that allowed money to move. In the next episode, we will examine how this financial superiority was tested during periods of crisis and why the system managed to remain standing. The true power of global finance is measured by how a system reacts in moments of crisis. The structure, built by British bankers, was tested by numerous financial shocks throughout the 19th century. Wars, trade bubbles, bank failures, and sudden capital outflows shook the London market many times. Yet what was remarkable was this. Although the system was shaken, it did not completely collapse. There were two fundamental elements behind this resilience: central bank support and liquidity management. The Bank of England was not merely an institution that printed money. It also functioned as a lender of last resort. In moments of crisis, it provided liquidity to banks and prevented the chain reaction of panic from expanding. This approach marked an important turning point in financial history because it aimed to preserve market discipline while preventing systemic collapse. British bankers took risks, but they did not allow risk to spread in a completely uncontrolled manner. The crises of 1825 and 1866 were periods when this model was severely tested. Speculative investments and excessive credit expansion had escalated tensions in the markets. However, thanks to central bank intervention and the coordinated action of major banking families, the system recovered. What was critical here was the restoration of confidence. In the world of finance, panic is contagious. If investors believe that the payment system will continue to function, a crisis remains limited. The London market managed to preserve that confidence. British bankers had also gained an early advantage in portfolio diversification. They did not depend on a single country or sector. Instead, they distributed their investments across continents. This made it more difficult for a local collapse to bring down the entire system. Railway projects, mining investments, and overseas infrastructure financing were spread across different regions. In this way, risk was geographically diversified. This strategy strengthened Britain's position as a global capital exporter. Even when crises occurred, the system was able to maintain its flexibility. By the end of the third episode, the picture is clear. British bankers learned not only how to manage growth, but also how to manage collapse. Financial dominance belongs to systems capable of withstanding crises. In the next episode, we will examine the political and geopolitical effects of this global financial network and how debt diplomacy emerged. Financial superiority does not affect only economic outcomes. Over time, it also produces political and geopolitical consequences. The global sphere of influence, reached by British bankers in the 19th century, laid the groundwork for the emergence of a new power mechanism that could be described as debt diplomacy. When a country wanted to make infrastructure investments, finance a war, or close a budget deficit, it often turned to London financial circles. This was not merely a request for a loan, it was the beginning of a long-term financial relationship. Credit agreements contained interest rates, repayment schedules, and collateral structures. These conditions had a direct impact on the fiscal policies of the borrowing country. From budget discipline to tax regulations, indirect guidance began to take shape in many areas. British bankers were not an official state authority, yet through financial ties they were able to establish strategic influence. Latin America, the Ottoman Empire, and several European states borrowed heavily from London. During this process, infrastructure projects, railways, and port investments were financed. While these investments created economic growth potential, they also formed bonds of debt dependency. When debt restructuring or default risks arose, negotiation power was often in the hands of the creditor. This is the transformation of financial power into political maneuvering space. British capital was not limited to lending. It also made direct investments, acquiring company shares and concessions. This created more permanent ties than simple credit relationships. Since the financing and insurance of global trade routes passed through London, the party controlling the center of money flows also determined commercial risks. Debt diplomacy was different from military intervention. It was invisible but effective. Through this model, Britain was able to project economic weight in many regions it did not directly govern. By the end of the fourth episode, we see that financial domination is not merely about market share, but about the capacity to exert indirect influence over decision-making mechanisms. In the next episode, we will examine how this system reached its peak and how the sterling-centered financial order shaped global trade. By the late 19th century, the financial structure built by British bankers had reached its strongest level. London was no longer merely a center of trade and banking. It had become the heart of global capital. Sterling began to be widely used as a reference currency in international trade. Within the gold standard system, England's monetary policy had a direct impact on global price balances. Many countries conducted their foreign trade payments in sterling and held their reserves in London banks. This provided England with a unique advantage: easy access to financial liquidity and low borrowing costs. As global trade volume expanded, a significant portion of transactions passed through London, where letters of credit and insurance contracts were arranged. British bankers became the global reference point in risk, pricing, and capital allocation. Railway projects from America to Asia were financed with London capital. Mining investments, port infrastructure, and public borrowing were carried out with the support of British financial institutions. This meant not only economic magnitude but also system-building power. As the international use of the pound increased, Britain's sphere of financial influence expanded. Contracts denominated in sterling shifted the center of global pricing systems to London. In this way, Britain rose beyond being merely a trading state and became the manager of the global payment and financial infrastructure. This structure encompassed every link of the value chain: production financing, transport insurance, credit expansion, and sovereign borrowing. By the end of the fifth episode, the picture is clear. British bankers had built a financial empire beyond the military empire. Yet no system remains equally powerful forever. In the final episode, we will examine under what conditions this financial domination began to weaken and how global power balances started to shift. Although the model of financial Domination built by British bankers appeared strong and solid. For a long time, the balance began to shift as the 20th century approached. Global wars, rising public expenditures, and growing economic competition made it increasingly difficult to sustain the system. World War I in particular placed enormous pressure on Britain's financial structure. Borrowing increased rapidly to finance the war, and gold reserves began to decline. Sterling was still strong, but it was no longer the sole determining force. The rising economic power of the United States and the growth of the New York financial market gradually redirected global capital flows across the Atlantic. This shift did not happen overnight. Financial power slowly moved to the other side of the ocean. The model established by British bankers was still functioning, but absolute dominance was no longer in place. After World War II, the new international monetary system and the Bretton Woods framework elevated a dollar-centered structure. This marked the beginning of the end for the sterling-centered financial era. However, this did not erase Britain's financial legacy. London maintained its position as a financial center, continuing its influence in insurance, derivatives, and international banking. What truly matters is this: British bankers created one of the first modern examples of how financial dominance can be built. Managing income flows, institutionalizing credit systems, internationalizing a currency, and managing crises with liquidity. These elements remain the cornerstones of global finance today. Power does not come solely from production. It comes from the ability to construct financial architecture. Britain's bankers wove the world together with financial networks by using debt as leverage, financing trade, and systematizing risk management. Yet history reminds us of one key lesson: financial domination requires constant renewal. When competition changes, when reserve currency status is shaken, and when global power balances shift, the system must transform as well. This story does not only describe the past, it also holds a mirror to today's financial centers. Because while the rules of global finance may change, the underlying logic remains the same. Those who control money shape the game. If you enjoy this kind of global economic analysis, don't forget to subscribe to the channel, share the video, and write in the comments which financial empire we should examine next.